let's talk about long-term capital gains in a taxable brokerage account. And for many people, and especially married couples, this can be one of the most overlooked ways to reduce tax and potentially retire earlier. We'll walk through a few simple visuals in a moment, including how this works at the federal tax level and for some of the state long-term capital gains considerations to be aware of as well. But what really matters is how this fits into your own life, your timeline, your decisions, and what you actually want your future to look like. Because this is not just a tax and investing topic, it's a timing and lifestyle conversation.
And over 10 years of guiding people to retire earlier, wealthier, and happier, ideally, this is part of the plan that doesn't get talked about as much as the 401k or the IRA or the Roth IRA, but it can play a meaningful role in how you structure taxes, structure your life, structure maybe retiring earlier or having a more successful retirement with your investing and retirement income, especially in the years before traditional retirement accounts are accessible without penalties, fees, or restrictions. In our longer videos on the 5 tax and income layers that support early retirement, we call this layer 1, the flexibility layer. And for many couples especially, this is the layer that determines whether retiring earlier is actually possible. It is also a layer that should be built alongside of, not instead of, your traditional retirement accounts.
Yes, and this is one of those areas where we consistently see couples, especially not because it's complicated, but because no one has ever really shown them how it applies to them together. So instead of just explaining it, we're going to help you see how it actually fits.
Yeah, my name is David Lundberg. I'm a flat fee fiduciary financial planner and tax strategist, co-founder of Awaken Financial Designs. I do have 2 master's, certificate in financial planning, Marine veteran, and have been doing this now for over 10 years.
Yes, and I'm Ashley. I'm a co-founder of Awaken Financial Designs. I have my master's degree in business leadership, and I am a wellness coach and financial educator. We're also both certified in yoga instructors, pranayama, breathwork, and meditation.
And as always, this is educational only, not financial, tax, or legal advice. Always be aware of your own situations, goals, needs, and impacts as well. So Ashley, let's get into it today.
Yeah, just before we dive deep, visuals and explanations, we have to truly know the purpose. So here's the situation we see almost all the time, especially with couples in their late 50s and older, and also with people in their 30s and 40s, and even 50s can do now. They've done what they've been told to do for retirement. They've built up their 401k, contributed to IRAs, maybe a Roth IRA. They might even have a pension. But in many cases, they've also had small amounts of money sitting in a brokerage account and cash in the bank. From the outside, everything looks solid, but internally, the question starts to shift. It's no longer just, are we saving enough? It becomes, how do we actually use what we've built if we want to step away to retire earlier, especially before 60, before 59 and a half, sometimes even before age 55, before Social Security really makes sense to claim, because most of what they built is in the accounts with rules, fees, and various tax impacts. The 401k, TSP, 403b generally aren't accessible without penalties before a certain age, unless very specific strategies, if allowed, are used correctly, like Rule of 55 or a 72T. Roth IRA accounts have their own structure around qualified distributions and age impacts prior to 59 and a half. So what happens is that they've done everything right, but they still don't feel like they have that flexibility. And that's where the real question shows up. Where does the flexibility happen? So what are long-term capital gains? What are the federal and state tax impacts? And why does this actually matter if you're thinking about retiring earlier and creating more net income in retirement? Because this is one of those areas where that small shift in understanding can truly lead to a very different outcome over time.
Yeah, so let's get into here. We're going to show you several visuals on here coming in
Yes.
now. But first off, what is a long-term capital gain in that taxable account, like that
Right.
brokerage account as an example? Well, if you've held that security, that stock, ETF, mutual fund, or similar for more than one full year, and if there's a gain on that security and you sell it in that account, you get to utilize the long-term capital gains tax rates, which are typically more favorable, which we're going to show you here in a moment. As opposed to if you've held it for less than a year and you sell it at a gain, you get the ordinary income taxes as usual, not the more favorable one on there, which is why we have this. So coming to the screen here, we can see the federal income taxes that we can see on here. These ones most everyone's common to. It's how your W-2 is taxed, everything as well. But what I want to show you on here is that this is also how your money in the 401k is taxed. Your money in the IRA, the TSP, that 403B, this is how they are taxed when qualified withdrawals are taken out. They're taxed at the federal level on here. Also, these short-term capital gains are also taxed at this federal level here as well. And you can see it goes from 10% to 37%. There's obviously a single filer, then there's obviously married filing jointly, different income levels as well. But again, we want to focus on long-term capital gains and how those are different. So now coming up here next on the screen, we can see the federal, this is not state yet. We will go over state taxes here later on. This is the federal long-term capital gains tax bracket. Big difference. Now we have 0%, 15%, and 20%, so 3 only. We're going to focus on here the individuals or the married filing jointly on there. But as we can see in here, that's a huge difference with that $0, but you can get up to $98,900 in long-term capital gains, 0% or tax-free. However, later on, we're going to discuss how the IRA and 401k and other taxable elements impact this. But this is just showing you that if the only income you had in the year, the only taxable income you had in the year was only this, you could get up to roughly $98,000 in gains as a married filing jointly individual. So we can see how powerful that chart is, but we're going to go over more later on as well. And this is where it becomes especially meaningful for couples, because depending on how your income is structured and how other investment tax account types, married couples filing jointly usually qualify for a lower, or certain situations, potentially even get that 0% tax because they have more income on there and that long-term capital gains. Now, it's not about chasing something new. This has been around for a long time. It's about clarity. It's about awareness. It's about understanding in this system so you can apply it to your own life so that maybe you can retire earlier. Or maybe this can help you in retirement in general to have more success and more net greater incomes as well when used intentionally.
Yeah, and this is where most couples realize that they've truly been overlooking this taxable account and long-term capital gains account this whole entire time. But here's what makes this even more important. It's not just federal taxes that apply here. Your state taxes, long-term capital gains too. And that can change the picture overall as well. So for example, here are 2 states that we commonly help people in, North Carolina and Arizona, and their long-term capital gains tax rates.
Yeah, so Ash was saying on his coming on the chart now. Now we have 2 states on here. We have North Carolina and we have Arizona. Now it's important that whatever state you live in, right? You need to go research. Hey, what are the long-term capital gains in my state? Some states have a much higher tax on there. Some states are structured on there, so they are different. But again, in North Carolina and Arizona, they are a flat tax rate state on here. However, in North Carolina, it's 3.99%. Now, long-term capital gains don't get anything special. So long-term capital gains or short-term capital gains, they tax it the same on there at that 3.99%. Now in Arizona on there, they also have a flat tax rate on there. However, in Arizona, what they do is they have a 2.5% flat tax. But for long-term capital gains in Arizona, they give you a discount on that as well. So they give you a discount off of that flat rate. So your effective rate on long-term capital gains is 1.875% on long-term capital gains. So these are just 2 states of many out there. Again, some states cost much more money out there. Now remember, it's the federal plus the
Plus
state
the
on top
state.
of that. They don't stack them together. They're each taxed separately on there, but
yeah.
there are two amounts that you have to be aware of, but you can see how taxes can be quite different. And again, that was just North Carolina and
Right.
Arizona. There's other states out there that you need to be aware of, and that is where everything starts to connect as one cohesive plan, because now you're not just looking at an account type. Now you're looking at how different types and incomes are taxed, from long-term to short-term
Wow.
to state to
I know,
federal.
so nice.
Keep in mind that Social Security benefits tax. Keep in mind the Medicare and IRMA look-back periods on there and how it affects your overall plan. And that's why when we do our one-time plans or our on-time plan that we have on here, these concepts, we show them our inner plans because you can visually see these tax structures. You can visually see the impacts. You can visually see how contributing to certain account types may or may not be beneficial for you.
So what you're saying is it's not just about what you earn, it's about how that income is structured, and where you live plays a role too.
Yeah, absolutely. That's why some people will move to certain states when they retire on there, depending on a number of
that
factors.
makes so
where you
much
want to be
more
aware of where you
sense.
live.
Yeah.
Because also maybe you retired and went to another state where it costs more money now and you weren't aware of it. So you have to be
Right.
aware of these things and be proactive about it on here. And keep in mind, because again, you have the federal, you have the state, you have short term, you have long term,
Wow,
you
there's-
got the IRA, the 401k, the
my
pension.
goodness,
So
yes.
again, you just want to be aware of these taxes on there to see how it all fits in your plan so you have that awareness and you have that clarity.
Yeah, and so for couples in North Carolina and Arizona especially, this isn't just a detail. This is one of those most important conversations to truly understand before you start drawing from your accounts. Because the difference between understanding this and not understanding it, that shows up in real dollars with real time and real impacts in your real plan for your real life.
Yeah, so what restrictions now, right? People
Yeah.
are usually not aware until it gets too late, but for most 401k accounts and most IRAs and similar, they do have the age of 59 and a half
Right.
years old, including Roth IRAs. People don't know this, but Roth IRAs too. And if you take
That's a
that
good
money
point.
out prior to 59 and a half, there's usually a 10% early withdrawal penalty plus the applicable taxes.
Right.
Now, of course, in a Roth IRA, your contributions are already taxed, so those can be taken out tax-free, but any kind of earnings or growth potentially would have that penalty as well on there. Now, when it comes to the 401k, Ashley and I talked about earlier in prior videos, if your plan allows for a 55 age limit, that's your own 401k, your own
Right.
HR, you can ask about the rule of 55 with them. Or there's a 72T, which is another tactic in private as we go over on there regarding the 401k and IRA structure. However, with a taxable brokerage account, there is no age limit. It could be age 40, age 50, it could be age 60 on there. There's no additional fees for taking your money out at an earlier point in life. And it also has that long-term capital gains. So we get rid of the age restrictions, get rid of the extra fees that are on there, the extra blocks that are on there, and your employer is not just going to control that on there. So you get that freedom, that flexibility, that time.
Yeah. So when somebody asks, how do people actually retire at 55 or 57? It's usually not about finding something new. It's about understanding, right, what they already have and using that intentionally. And for many couples, that taxable brokerage account with long-term capital gains, that's one that's often treated as like their extra or their afterthought, becomes a meaningful part of that answer. And more specifically, how the gains inside that account are taxed and when they're used. And this isn't just for people close to retirement. If you're in your 30s or 40s, this is where that awareness becomes powerful, because you can start to build towards this kind of flexibility now instead of trying to have to figure it out later.
Yeah, as Ashley touched on, if you're in your 30s or 40s, what if you could find out now, hey, I only have so much money every year. Where should I put this money? Do I put it in my 401k? Do I go into the match, past the match? Do I go to the IRA, Roth IRA? Do I go to the taxable brokerage account? Because if you can become aware of now of where to put that money, you can start changing up your allocations of how that money's going in there. Who knows what that future impact could be in the future as well, which is why we look at things on a holistic, cohesive level so they all fit together. We don't just have one piece here, they're a whole unit as one.
Yeah, and this is where I want to pause, because this is specifically why we talk about this as a married couple: tax, investing, retirement planning topic. Not just an individual decision, but something that works differently when you're planning truly together. David, earlier you explained the two different states tax long-term capital gains differently, like Arizona and North Carolina. But does it married if you're single or married as well?
It's a great question on there. So when it comes to Arizona and North Carolina and most other states on there with long-term capital gains, it's the same. So whether you're individual or whether you're married, there's no impact on there. So unlike the federal tax chart, there's an impact of being married or single. Unlike the long-term capital gains federal chart, again, impact married or single. But when it comes to the state tax rates on long-term capital gains, in this case, Arizona and North Carolina, they treat it the same. Other states might be different, so check your own state as well. But again, it's about that awareness and that clarity so you're aware of that. And that's why it's all about planning. It's about this awareness of, hey, could I retire at 55?
Yeah.
What accounts could I draw from? Are there fees? Are there limitations? Are there tax impacts? Or maybe a regular retirement? How do I have greater net investing income as well on there?
So this is especially, important for couples to understand this and plan for it. Are not necessarily saving more than everyone else. They're structuring things more intentionally. They're looking at how the different accounts work together, how income is created over time, and how that supports the life that they actually truly want to live, and hopefully be able to retire earlier, or at least a successful retirement. And that is exactly what we mean when we talk about that wealth and life alignment. Your financial structure and your life timeline working together, not separately. And if you're single, this does still matter because life changes, whether that's a shift in income, a transition, or something like a divorce or unfortunately loss, can change how your financial picture works almost overnight. And having that flexibility across different types of accounts, including the taxable accounts, that can really help.
Yeah, and actually a good point is the spouse passing away. We have several prior videos and several prior articles on here as well. But when someone passes away, how they inherited an IRA with those taxes, how they have inherited Roth IRA and taxes, or the inherited taxable brokerage account gets a step up in basis, how your spouse receives an inheritance, how your spouse is then taxed, or your loved one is then taxed is very important too as well, which is why this taxable brokerage account is also beneficial as a layer for estate and legacy planning. And that's part of our wealth and life alignment guides and process.
Yeah, so if you do have a taxable brokerage account and you've been wondering what it's actually part of your early retirement plan, it very well may be. The question isn't whether you have the account, it's whether you truly understand how it fits into your overall structure, how the gains inside it are taxed, and how that timing works alongside everything else you're building. That clarity is truly what changes that retirement plan for couples. And even if you're in your early retirement journey, your 30s or 40s, this is where that proactiveness can really start.
Yeah, it's about having flexibility. It's not have more control, more awareness with your taxes, with your investments, with your fees, both while you're alive and while you're passed away. It's about having those income layers that we always talk about. It's about having those various protections we always talk about, having that tax diversification that we always talk about, because these do also impact your Social Security benefits in the future. It can impact your Medicare and IRMA in the future as well. But if this can help you either A, have more money throughout retirement, or it can B, allow you to retire years earlier, it's good to have that awareness and wherever. Ashley, where can they go to find out about the Wealth Alignment Guide?
Yeah, if you're interested in the Wealth Alignment Guide, we have it for free on our website, awakenfinancialdesigns.com.
And can they also book a free discovery call as well, Ashley?
Absolutely.
All right, so we have a free discovery call virtual on there as well. And again, if you're especially in the Arizona or North Carolina area where our RIA is licensed on here, we'd be more than happy to speak with you on there. And also, if you're virtually in other states, we might be able to help you as well where we are licensed or eligible if so too. Ashley, any final marks?
No, if this was helpful though, feel free to leave a comment. We do read them, every single one, and subscribe if you'd like to continue learning alongside us.
Thank you so much for being here. We're so grateful for your time and your energy. Please share this with someone else if you liked it or comment below. Thank you. I skipped a lot.